This video is all about the Opening Range Breakout, also known as ORB. We'll learn what the Opening Range Breakout really is, how it works, and the key things you need to focus on when trading it. So let's dive in and get started. First, let's understand what an Opening Range Breakout really is. If we break down the term, it's made up of two parts: opening range and breakout. On the chart, to define the range, we look at the opening and closing levels of a specific candle. The difference between these two levels is what we call the range. Now, whenever the price breaks this range and closes above it, that's called a breakout. Unlike some other strategies where we mark an external range on the chart, here we focus on the range of a particular candle in a specific time frame. For example, if we're using a 15-minute candle, we mark its high and low. The space between them becomes our opening range, with the high labeled as opening range high and the low as opening range low. In our strategy, we focus on marking the range of a 15-minute candle. Here's why. If we use a higher time frame candle, the range becomes too large, making it harder and slower to take trade entries. On the other hand, marking the range on a smaller time frame results in a very small range, which increases the chances of taking incorrect entries. So using the 15-minute candle strikes the perfect balance. The range is neither too big nor too small, allowing us to trade more efficiently and accurately. Now, let's understand how the opening range breakout strategy actually works. But first, here's an important point. This strategy works the same way in any session, whether it's the London session, the New York session, or any other. In this video, we'll focus on the New York session. So, how do we start? The first step is to decide which candle's range to mark. Many beginner traders make the mistake of marking the range of the very first candle of the session. This is not recommended because the first candle often has higher than normal volume, making its range unusually large. A bigger range can be problematic for entries. Sometimes the market moves sideways within this first candle's range, meaning your entry might never trigger. That's why in the opening range breakout strategy, we always mark the range of the second 15-minute candle. This second candle provides a safe and reliable range for taking trades, balancing accuracy and efficiency. Once we've marked the opening range on the chart, the next step is to shift to a 3-minute time frame for entry. We use the 3-minute time frame because entries taken on the 1-minute time frame often result in false signals. Now comes the most important part: which entry model to use when trading the opening range breakout strategy. There are 3 types of entry models. First entry model: price breaks the range and closes above it. The problem with this model is that price often forms a reverse candle immediately afterward, closing back inside the range and hitting your stop loss. Second entry model: after the breakout, price touches the opening range again. This is where we take our entry. It's the most reliable model. Third entry model: here, after the price breaks our opening range, we need to wait to take an entry until it breaks the recent high. The issue here is that your stop loss becomes very large, which negatively affects your risk to reward ratio. That's why we always use the second entry model. As soon as price touches the opening range, we take our entry. And one more thing, here we're discussing a buy-side breakout, but if a sell-side breakout occurs, the rules remain the same. When trading the opening range breakout strategy, another scenario sometimes occurs. Here, the price breaks out of the opening range, but instead of retesting our level, it moves down and then comes back inside the range. For example, in this case, the price broke out of the opening range, but instead of testing the level, it moved down and re-entered the range. Here, a fair value gap was formed. By marking this fair value gap, you can take a sell-side trade with a clear and precise entry point. Now, let's look at a live chart example. First, we mark the range of the second 15-minute candle, which is the 9:45 candle. Once the range is marked, we shift to the 3-minute time frame for entry. Next, we wait for the range to break. Here, the price breaks our range. For the entry, we need to check the PD array. As you can see, a fair value gap has formed. Mark this carefully and wait to see if the market gives us an entry. Here, the price hits our entry. And this is where we take our buy-side entry. The target will be the next liquidity level. One important point: before entering after a breakout, always check the higher time frame to ensure there's no major resistance. If resistance exists, we skip the trade. And that's how we trade the opening range breakout strategy.